Welcome everyone, I'm Ted Erhart. I want to spend just a few minutes today talking about a subject I think we're going to be hearing a lot more about in the coming weeks and months. That being the Federal Reserve's balance sheet. Now to be sure, this isn't meant to be an academic discussion. Rather, the objective is to explain in basic practical language what the Fed's balance sheet represents and why it matters so much to the financial markets and the broader economy. Let's get started. So first and foremost, I want to be crystal clear. We're talking about the Federal Reserve, which is the central bank of the United States. It's often referred to as the Fed for short. And I think this can be confusing to the average person because the Fed could be mistaken for the federal government. But that's not what we're talking about. What we're talking about today is the Federal Reserve's balance sheet, and I want to emphasize that this is distinct and independent of the United States government. Now, explaining these concepts is challenging because you almost always need some foundational knowledge. So, for example, one of the key tools that the Fed has is its ability to create money out of thin air to purchase financial assets, specifically bonds. Now, why does the Fed do this? Well, I've done some separate videos specifically on this topic, and I'll make sure to provide those links. I'll try to link up here in YouTube or down in the comments on one of the other platforms if you're watching there. And frankly, you might want to start with those previous videos and come back to this one because, again, they provide that foundational knowledge around bond buying that I think is important in understanding this broader concept. Now, at risk of oversimplifying, the Fed balance sheet basically is an accounting of its money creation and destruction activities which it engages in to provide either support when the economy is weak or to cool things down when the economy is running too hot. So these activities are done through bond purchases or sales, and this is what the balance sheet is ultimately keeping track of. So what does the balance sheet really tell us? Well, put simply, it provides us some insight into the scale of the Fed's actions as it relates to its interest rate objectives or its response to major financial shocks. So for example, if you look up here at the chart, this is right off the Fed's website. And this isn't the balance sheet, this is a graph of the balance sheet, specifically the assets on the Fed's balance sheet. And this is what financial media is always obsessing about. So in this graph, you can see the Fed's assets on the balance sheet going all the way back to about 2007. And what's interesting, specifically, I'll point out a couple things. You can just vividly see two of the greatest economic shocks of the last century. So if we go back here to the 2008 time frame, you can see the global financial crisis. The balance sheet basically doubled overnight. And of course, more recently, out here in 2020, we can see another virtual doubling of the balance sheet over just an extremely narrow period of time. So if you're asking yourself, okay, this is interesting, but what am I supposed to take away from this? Well, again, what the balance sheet tells us, it basically provides us some quantitative data so we can understand the magnitude of the Fed's actions over time. So let's specifically look at the Fed's response to COVID. If we look early on, leading into the pandemic, the balance sheet was hanging around or hovering around $4 trillion worth of assets. But then in just an instant, it spiked up to approximately $7 trillion. So a roughly $3 trillion change. To translate this, what it means is the Fed's initial response to COVID, particularly in March, April of 2020, there was a financial panic effectively unfolding. The Fed's response to that was the creation and injection of about $3 trillion into the financial system. And again, if you're looking for a deeper explanation of how bond buying stops financial panics, check out those past videos I did where I really address that subject specifically. Now, after the initial pandemic shock, the Fed continued to make about $120 billion a month worth of bond purchases to suppress long-term interest rates and just flood the markets with liquidity. And those bond purchases, without question, had the effect of supercharging both real estate and stock prices. And the way to think about this is, the Fed's balance sheet, again, you look here, has basically ballooned from about $4 trillion just 24 months ago, roughly, to over or approximately $9 trillion today. So to translate, this tells us that the Fed's total response to COVID from a money printing and bond buying perspective amounted to about $5 trillion. You know, once you get into the billions and trillions, the numbers become very abstract. So let me provide a little context here. If you divide 5 trillion by the roughly 130 million households that exist in the United States, you come up with a figure of nearly $40,000 per household. When you think about this, it's no wonder we've seen spikes in real estate prices and shortages of basically everything. All this liquidity, this $5 trillion, has just been sloshing around the U.S. economy for the last 18 to 24 months, and it's looking for something to buy, obviously from goods and services to financial assets like real estate and stocks. So why does Wall Street care so much about the Fed balance sheet? Well, basically it's very simple. The concern is if money printing and balance sheet expansion result in surging economic activity, rising asset prices, well, it stands to reason that the reversal of those policies is likely to weigh on economic activity and likely result in headwinds, that is, declines in asset prices like stocks and real estate. And that just brings me to the last chart I want to show you. There's been versions of this bouncing around for a good 5 years. And basically what this is graphing is the change in the Fed balance sheet in the orange line against the United States stock market. And look, this is amazing. So I am the type of person who typically doesn't pay much attention to this stuff in the context of investing. I'm much more of a bottoms-up investor versus a top-down macro type person. But that said, this chart just blows my mind how tight the correlation is between the Fed's balance sheet and the stock market. As we've seen over the last 15 years or so, as the balance sheet has expanded, stock prices have gone up. When the balance sheet has plateaued, so too have stock prices. The last time the balance sheet was contracting, we got a bear market essentially in the fourth quarter of 2018. So there's definitely some evidence to suggest that this concern is warranted. And unfortunately, for investors, this is what the Fed has to do. Right now, we are in the midst of the highest level of inflation basically in 40 years. So the Fed has to take action to try to cool things in an effort to restrain inflation and get it back down to their target, which in recent years has been stated at around the 2% range. So to summarize, the Fed balance sheet basically serves to quantify the scope of the board's policies. What matters most to the markets is the trend of the balance sheet. If the balance sheet is expanding, this means that the Fed is creating money and pumping liquidity into the financial system. This provides economic stimulus and tends to provide tailwinds to the financial markets. But when the balance sheet is shrinking, this represents a tightening of economic conditions, which has historically been associated with lower economic growth, even recessions, and therefore turbulent market conditions. So it's definitely going to be an interesting next 12 to 24 months. But look, if you enjoyed the video today, I'd really appreciate a thumbs up. And look, I hope you'll consider subscribing to the YouTube channel if you're watching on that platform. Again, thanks for watching, and I hope we'll see you on the next one.